All right, everyone. Welcome to Markets and Economy here in March of 2025. I think as I was looking at like the wild weather that seems to be happening everywhere, feels like everything is just kind of going wild a bit. So that's the topic we'll be hitting on today. I'm Jarrod Musick. I'm the CEO and on the investment committee here with Tim at Destiny Capital. So thinking about all things investments and how we translate those through for our client families. Tim?
Yep, my name is Tim Doyle. I'm the Chief Investment Officer here at Destiny Capital. I manage our investment committee. We are responsible for investment manager selection, fund research and due diligence, asset allocation, portfolio rebalancing and trading, everything investment related. And I get to play armchair economist from time to time, especially during days like this where we're talking a lot about tariffs and trade and all that good stuff. But I'm excited to be here. It's a timely webinar. There's a lot going on, and I'm excited to get everybody up to speed on what we're seeing.
Awesome. And as we always need to before we start our conversations here, just a reminder, this is for educational purposes only. We've made every effort to make sure that the data and information that we're showing you and talking about is as accurate as possible. It's possible we made errors, so please do not make any irreversible financial or life decisions based on the content of what we're talking about here. If you already work with our team, reach out to your team here. We're happy to talk to you about anything that is going on and how it may tie into your particular situation. Talk to your CPA, tax professional, outside advisor, all of those good people before you make any decisions. We're going to talk about a few individual securities here. So we may maintain positions in those securities, but it doesn't have any bearing on why we're talking about them today. So trade policy. We're recording this here right after March the 4th. Tim, do you want to walk us through what's happened recently with tariffs and trade policy?
Yeah, and I want to state the caveat that all of this could be in play or none of this could be in play by the time you are watching this, or even by the time I'm finished this sentence. It is a rapidly evolving situation, and we're going to cover things as they stand right now. We did get some news hot off the presses right before we jumped on this webinar, so we'll be talking a little bit about that. But we want to talk about tariffs and what that might mean for the U.S. economy, for the global economy, and so forth. So on March 4th, the Trump administration implemented 25% tariffs on Mexico and Canada, with a 10% carve out for Canadian energy. So that portion did not get the full 25% tariff. While increasing Chinese tariffs by an additional 10%. So Donald Trump in February had already increased Chinese tariffs by 10%, in addition to what was already in place. And then we got another 10% on the 4th. So essentially, year to date, there have been a 20% increase in tariffs on China. So what does that mean and why? So why did this happen? Well, we have to understand why, we have to look at the 3 executive actions signed by Donald Trump in February. So according to these 3 executive actions, these tariffs and this trade policy has very little to do with actual trade policy and everything to do with immigration issues at the northern and southern border and fentanyl smuggling and production as that flows into the United States. So in that case, obviously, China is not on our northern or southern border, but they are viewed by the Trump administration as a mass producer of fentanyl and the chemicals that can produce fentanyl. And he's looking to damper that. And these tariffs are in place in an effort to do that. Why is this important? Well, I would consider these 3 countries the big 3. These are our 3 biggest trade partners by far. And you can see that in the charts at the top right here. This lightly blue colored chart on the top right, where we have, you can see pretty clearly that Mexico and Canada are our 2 top trade partners. And this chart, I should note, it includes both U.S. or both imports and exports. So it's an aggregate import-export number, not just imports or exports. But as you can see, China is up there as well. China has slipped a little bit in recent years. China was one of our largest, if not our largest, as you can see by the chart, trade partner. That's been trimmed back a little bit in recent years. That's partially due to COVID and people diversifying supply chains. It also has to do with some of the tariffs that Trump implemented in his first term. But these are clearly huge trade partners of the United States, and it's a very important development. Our economies are heavily intertwined, especially when you talk about the U.S. and Canada and Mexico. And to talk about that, we look at the USMCA, so the U.S.-Mexico-Canada Agreement, which is the trade agreement that was in place between these three countries leading into this tariff and this trade war. This was the USMCA essentially replaced NAFTA, the old trade agreement that allowed for free trade across the North American continent. And the USMCA was negotiated by Donald Trump in his first term back in 2018 and signed then. But as of this date, I think I don't know if that even exists anymore. I think that's kind of been cast aside with some of these actions that have taken place. So you know, that's obviously a big development given how intertwined these economies really are. Before I go on to talk about response, anything you wanted to add there, Jarrod? Any other context you wanted to talk about as it relates to these tariffs and the big three in particular?
I think it's important to just, you know, going back to your chart in the upper right-hand side, that is the vast majority of our global trade is with those three countries. So when we talk about it seems very targeted, and it may be if, you know, immigration and fentanyl smuggling are truly the drivers of this, but they are imposed on the majority of our international trade at this point. So it's a significant impact, whether it was intended to be targeted or broad-based or not, it is what it is at this point. So just as we continue the discussion, I think that's something to bear in mind.
Yep. Yeah, thank you. And then that leads us to the response. So the response has been somewhat mixed. So Canada has announced that they will respond with 25% tariffs on $155 billion of American goods. That's Canadian dollars. That equates to about 108 billion US dollars, give or take. As far as this is concerned, they're taking kind of a wait and see approach. So 30% or 30 billion of that 155 billion will go in effect immediately. So as of today, these are in effect on those $30 billion worth of goods. Tariffs on the remaining 125 billion will go into effect around March 24th, give or take a day or two. So I think Justin Trudeau and you know, the Canadian government, they're trying to give some time for negotiations to reemerge and to make some progress without going all in on the 155 billion of tariffs, because they know that can be very damaging, particularly damaging, and we'll get into this to Canada and Mexico, but we'll get into that a little bit on the next slide. So China also responded, and China has announced retaliatory tariffs of 15% on chicken, wheat, corn, and cotton, and 10% on soybeans, pork, beef, fruits, vegetables, dairy products, and others. So heavy into agriculture. So you can look to see an impact there. A lot of strain on farmers and so forth. They're going to be having questions about that and what that means for them in the short term and the long term. As it relates to Mexico, we haven't seen any announced retaliatory tariffs yet. Again, that could be changing as I'm talking right now, but that's something obviously we're going to be keeping an eye on. A little bit different strategies. It's important to keep in mind that these countries do have political pressure of their own and political will to respond. So there's a lot of pressure on leadership in Mexico, in Canada, and in China to retaliate, and they're trying to take what they deem to be a measured approach in response to these tariffs. So we'll see what happens, but we would expect some kind of response from Mexico if the tariffs do persist in perpetuity, or at least for the short term into the medium term in the next few months here. Before we get ahead here, the market reaction is the next thing I want to talk about. Markets have reacted, as you would expect, with volatility as we really try to navigate the elevated uncertainty around the economic impact of this policy. So I think one of the biggest questions is around staying power. Are these tariffs going to be in place for a long period of time? Are they permanent? Are they short-term? Are they a negotiating tactic? Are they intended to provide revenue for future tax cuts? You know, there's a lot of moving parts here that investors are trying to figure out. And when there's uncertainty, there's fear. When there's fear, there's volatility. And we see that to the chart to the bottom right, where we see year-to-date major index returns. So We've got the S&P 500 roughly flat. And I want to point out that this chart was as of March 4th. Markets are up a little bit as I'm writing this, or as we're talking here. But the S&P 500 was roughly flat on a year-to-date basis. But we saw some of the riskier asset classes. So the NASDAQ, which is heavily invested in tech and more growth-oriented stocks, that's down about 5%. The Russell 2000, which are small caps, down over 5.5%. And then the Dow Jones Industrial Average up. Dow's generally considered a little bit more conservative, more established companies, dividend-paying companies. They don't fluctuate quite as much, and they're hanging in there a little bit better than particularly the NASDAQ and small caps and so forth. We do see bonds actually hanging in there quite nicely. Bonds, as we were hoping, would provide a ballast during periods of volatility. So fixed income bond markets are up about 3% on a year-to-date basis, and counteracting some of the volatility we're seeing in the stock market, which is as intended. That's how we construct portfolios. That's what we want to see from our fixed income allocations. So that's encouraging that we're getting that. So our investors, or many of our investors, aren't feeling the full brunt of that volatility that you might be seeing in the NASDAQ or even the S&P, as markets have moved down from their highs and sold off, 5, 6, 7+% in the past few weeks. So before we get to the next slide, anything else you wanted to add there, Jarrod?
Again, just pointing back to diversification in investments, and part of the reason why we continue to advocate for geographic diversification, diversification in the types of companies that you own, and diversification into different asset classes. So whether that be, bonds, different types of bonds, private credit, a lot of different assets are going to perform differently during periods of stress. So I think the chart in the lower right is a perfect example of when you have uncertainty. It's actually been a pretty decent environment for bonds, which we haven't seen for a couple of years. So
yeah,
I think that just has jumped out to me so far this year, that sometimes diversification is there for a reason.
Yep. Yeah, we look when we're making asset allocation decisions, we look at correlation. So do asset classes move in the same direction all at once, or do they move disparately from one another? One goes up, the other goes down a little bit. Not everything's moving in the same direction, and that's an important part of portfolio construction, is building in lack of correlation. So asset classes move in one direction, you have something else that can provide ballast during periods of volatility, just like fixed income is doing right now. So we'll move on to the next topic. I know we just had the Oscars, and I think this was the Oscar winner, one of the big winners from last year, Everything Everywhere All at Once. So it's kind of what we're talking about as far as the trade policy is concerned. When we're talking about potential next steps, we already know what's in place so far for Canada, Mexico, and China. But President Trump has expressed his not just interest, but intent to implement reciprocal tariffs on trade partners across the globe. So this is interesting. You can see on the chart to the top right, where we have if we were to implement reciprocal tariffs, what impact would that have across the globe as far as increasing effective tariffs on other countries? So as you get, you can see in the light pink, that's maybe a 5%, 10% increase in effective tariff rate. Whereas you go to the deeper purple colors, that's a 25% plus tariff increase. And before we get into that too much further, I wanted to talk about one thing that Donald Trump and his administration are targeting, and that's value-added taxes, or VATs. This reciprocity may include VATs, and it's important to understand what they are and how they operate to see if that's appropriate, or if it poses challenges to eliminating VATs or reducing them. VATs are taxes that are assessed at various stages of production. So in the US, we have a sales tax. Somebody buys something, you buy a refrigerator, you pay a sales tax at the point of sale. If you make and produce a refrigerator in the European Union, that VAT is assessed at different stages of production as well as at sale, even though that's trimmed down significantly. It's not an all-at-once tax. It's slowly over time. So it's akin to a sales tax in the United States, and in the European Union and many other countries, they utilize VATs instead of sales taxes. So it's a significant source of revenue for a lot of countries. So if you look at the chart to the top right, one country that immediately stood out to me was Sweden. Sweden is a very hopefully you're good at your geography. I don't know if I can circle this here, but Sweden is the dark purple. They're just north of Europe, and you can see, at first glance, you could be just saying to yourself, well, Sweden's really screwing the United States. Look at it. Like, if we raised our tariffs, we'd be raising them 25% to meet theirs. Like, what do they have imposed on us? Whereas in reality, Sweden has a 25% value added tax. So all of that almost entirely would be the VAT portion of that trade impact. And it's important to note that VATs affect both domestic goods and imported goods. So whatever's produced in Sweden gets a VAT. Whatever is imported from the United States into Sweden has a VAT applied. So it's just largely considered by economists to be trade neutral. But I think the most important element is the fact that it is a significant source of revenue, not something that can be easily cut in the European Union. The European Union has a minimum for membership in the EU. You have to have a minimum VAT of 15%. So that's considerable, and they rely on that revenue for public projects and government functioning and all those things that we rely on as it relates to sales tax. So, an important caveat. I wanted to highlight that because I think you're going to be hearing a lot about that in the weeks ahead as one of the potential challenges to reciprocal tariffs when it comes to, can the European Union, can all of these other countries lower what are perceived as tariffs and trade policy on the United States to make it reciprocal. Could be difficult. But anyway, we're headed in that direction. Jarrod, anything else you wanted to add before we go into the economic impact of some of this?
Yeah, I think if you're feeling confused, don't worry, you're among friends, right? This is not a very straightforward topic, because we're really mixing and mingling a couple different things here. One is geopolitics and negotiations between states about how we're going to interact with each other and buy and sell things from each other and trade labor and all of those things, right? That's a portion of it. We're talking about border security, criminal activity in terms of drug trafficking, different things like that. And then we're also talking about how do you actually go about raising revenue necessary for the functioning of certain levels of government. And those are all mixed in with tariffs and value-added tax. And so I think we're in a position where there's a broader discussion about what do you want activity-wise to occur inside the US? What do you not want to occur inside the US? And then from a government perspective, how big should the government be and how are we going to choose to pay for that? And all of that stuff is mixed into the public discourse right now. And so it's difficult to track. So we wanted to try and flag a couple of these things just so you have maybe a little bit more familiarity with some of the terminology that's being thrown around and what some of the impacts may look like. There is so much complexity here that we truly don't know what the ultimate impacts are going to be. What we're trying to do is help you understand from a sizing perspective what the impacts could be if things work out in a certain way. So I just wanted to clarify, if you're feeling confused, stick with us. Don't expect to come out of this understanding every little piece of it, because it's very, very complex.
I think, what you could take away. Thank you, Jarrod. That's excellent. Like, I agree 100% on all of that. I think what your takeaway from the chart to the right, probably can be the top right at least, is there's a lot of color all over that. So that impacts trade relationships everywhere across the globe on almost every continent. So it's a big deal. And that's kind of, we don't need to get into the nuance. I never thought I'd be on an investor call talking about value-added tax. This is really a first. But here we are. So, but it is going to be impactful. And there's still a lot of uncertainty. Will this go through? Will we learn lessons? Will things happen with the arrangement with Mexico, Canada, and China that impact future policy in the European Union, for example? We don't know yet. I think we're still probably a month away from knowing more about that, given some of the deadlines that have been talked about. But we wanted to talk a little bit about potential economic impact, given how vast the trade partnerships are across the globe, and how they could potentially impact things like inflation, GDP growth, and so forth. So to look at that, I've reviewed a few studies from the Yale Budget Lab. They've done a number of different scenarios. And in this case, with some of these numbers I'm showing you, is the reciprocity, the reciprocal tariff situation What if we implemented these tariffs, reciprocal tariffs on these countries? What impact would it have on inflation? Excuse me, we kicked ahead here a little bit. So inflation, as it relates to PCE, their projections are that it would add 1.66% to PCE inflation. So we're already above the 2% Fed target for inflation as it stands now. So this could be additive to inflation, potentially, which would decline household disposable income. So in a scenario where the U.S. alone is implementing these reciprocal tariffs, that could potentially decline household disposable income by $2,700, slow down in GDP growth by about 0.6%. Not a huge impact on the United States as it relates to GDP, but it does indicate more of a slowdown in GDP and slowing growth. That's essentially moving in the wrong direction. We want to see growth expanding. And a lot of the numbers I've seen and a lot of reports that I've read show this is the U.S. can weather this storm without potentially dipping into recession. I'm not going to say one way or the other whether that's a possibility. The U.S. is incredibly resilient in some of these scenarios, but excuse me, I've had a call coming in. But then when it comes to Canada and Mexico, they are looking at significant declines in GDP with many of the tariffs that are in place for them, and Mexico and looking at lower levels or higher levels, excuse me, of unemployment. So these are all potential impacts. This is one study done by the Yale Budget Lab that's not set in stone. It's just talking about some of the challenges that this proposes. And we wanted to bring some of those numbers to your attention. We may go there. These are all in numbers. There could be a lot of nuance that plays out here. And the bottom line, there's uncertainty. So, Jarrod, anything you wanted to talk about before I talk about the challenge for investors?
Nope.
Yeah, I think the challenge for investors is that, heading into 2025, the underlying fundamentals of the U.S. economy and domestic stock market remain strong. I think there's just put yourself in the position of a corporation, an auto corporation. So we got an extension. The auto companies in the United States got an extension on these tariffs. So no tariffs are in place for at least another month. But that's very, very difficult for them to make concrete decisions on how they're going to act and how they're going to produce and how they're going to allocate resources within their companies, because a month isn't a lot of time, and these tariffs could be in place a month from now. I think investors are in a very similar boat. Are these tariffs going to be in place? Are they going to be kicked? Is the can going to be kicked down the road a month, 2 months, 3 months, 6 months? Are we going to see piecemeal tariff? A lot of uncertainty, and that makes it really difficult to make high conviction investment decisions because if there is a reversal, let's say you go really defensive here and you think a recession is imminent, we could see in a week, we could see all these tariffs disappear and we could see a reversal in policy or some kind of concessions where everybody hugs it out and everything is fine, and then markets could pursue back on an upward trajectory. So you just don't know, and that's kind of where investors are, which is why we focus on diversification, as Jarrod talked about, which is why we focus on disparate asset classes that behave differently across the market cycle in constructing our portfolios. And that's more important now than it ever has been. So it helps us weather a lot of this volatility without thinking, what about my nest egg? What does this mean for my long-term retirement plans or my long-term plans for my business and so forth? So I'll leave it there. Jarrod, if you have anything else before we go on to some other individual stock positions.
No, I think the challenge for investors is a great way to, keep that in mind as we're looking into the individual positions on the next slide. I think that'll be a good way to kind of wrap up our conversation here today.
Yeah. So the not so magnificent seven, really heading into, and if you've attended our webinars before, heading into 2025, one area of focus and a considerable question was whether or not the Magnificent Seven stocks would continue to drive performance of the S&P 500 index as they had in 2023 and 2024, where they were considerable contributors to the returns in the index as a whole. So the Magnificent Seven, if you don't know, are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. So a lot of the big tech companies that have benefited from the AI trade. And what we've seen, at least in recent weeks, is a reversal of that trade. Essentially, investors taking what I would call a risk-off approach, where they're taking some risk off the table and moving out of some of these higher risk, higher valuation positions and reallocating a little bit. And that's caused some of these stocks to struggle. So, in fact, 6 of the 7 Magnificent 7 stocks are down on a year-to-date basis. We have Tesla down almost 30%. So that's obviously concerning for Tesla stockholders. Meta has been the only positive performer at roughly up about 12% on a year-to-date basis. But for the first time in about 2 years, the remaining 493 stocks in the S&P 500 index are contributing to returns. So they're actually performing fairly well and counterbalancing some of the volatility we're seeing in the Magnificent 7. Because the Magnificent 7 makes up so much of the S&P 500 index, about 35% on any given day of the S&P 500 is comprised of those 7 stocks. So it's been interesting to see that value stocks, so investors, as I alluded to, have shifted away from growth stocks a little bit, at least in the very, very short term. And we see growth stocks down about 4% on a year-to-date basis, whereas value stocks, when I talk about value stocks, I talk about more accomplished corporations that pay a strong dividend, that have been around for years, have steady cash flows. Maybe they don't grow quite as much as the Teslas or the Nvidias of the world, but they're steady Eddie, and those are up 4% on a year-to-date basis. So just interesting to see some of those dynamics shift. And it's a reminder for investors who have seen those Magnificent 7 stocks over the past 2 years perform so well that you don't want to put all your eggs in one basket. It can get very volatile, particularly with some of these higher profile stocks and where there's a lot of volume. And it's just something to keep in mind that you're not over allocating too much into just a few select stocks. It's really important to remain diversified. So we'll end with a positive, though, with an earnings update. We just essentially are concluding earnings season, where about 97% of the S&P 500 have reported earnings for the last quarter, and the blended earnings growth rate. So the growth rate of earnings is a very important measure that we monitor. And earnings growth rate was up 18.2% this past quarter, and that's well above the estimate of 11.8%. So earnings coming in very, very strong. That's a good thing. Of course, markets are forward-looking, and this actually occurred in the past, but that's a strong indicator that the fundamentals of many of these companies in the S&P 500 are strong, and earnings growth is expected to be strong throughout the rest of the year. So that's a positive. I know we covered a lot of jarring and somewhat confusing and difficult topics, but at least earnings season has been a strong one for investors. Jarrod, anything else you wanted to add there?
I think some of the things that we're going to be bringing to you over the next couple of months, we're likely to have more clarity on upcoming tax legislation. We will have more data on, as Tim said, are these tariffs at the right size? Are they going to be permanent? Are they temporary? Will they all be removed because we have different negotiations around immigration and drug smuggling and things that have happened? We don't know, but we will bring those to you. So we feel confident that over the next few months, we're going to get more clarity about the economic environment, the tax environment, and where things stand. But as of right now, corporate earnings look good. GDP growth looks decent. Inflation looks like it's not drastically different than it was over the last 12 months. So I think even though it can feel unsettled right now, and it certainly is, we're not at the point where, we have significant worries about a lot of things. It looks like we're overall in pretty decent economic shape at the moment, and we'll continue to update you as we learn more in the months ahead.
Yep. When things are changing so rapidly, I tend to believe in over communication. So you'll be hearing a lot from us. If there are events that come up that we deem important that you hear from us about, that might be a blog post, that might be another webinar, it might be some ad hoc communication that you'll be hearing from us or your advisors, your strategists, and your coordinators. So I think that's really important to stress too. And if you're feeling any kind of angst, please reach out to your client service team. That's what they're there for. They can communicate and work with our investment committee in any given way to help you navigate any challenges or any anxiety you might be feeling. But Change is coming fast and furious, and we're on top of it. We're keeping our eye on the ball, as we always do, and we'll be sure and communicate with each and every one of you as circumstances evolve, and they most certainly will.
Awesome. Well, thank you, all of you, for your very valuable time. We appreciate it. And yeah, we'll be back in touch soon.
Thank you, everybody.